In the past 2 years, gold has increased in value by over 35%, and in the last 3 months alone, it has increased by 17%.
It's on fire. Prices have touched a record high this week. Yesterday, gold prices in India crossed the 73,000 mark.
Well, China is on a gold buying spree. For the past 18 months, the People's Bank of China has been steadily accumulating gold reserves.
If you look at the Indian Central Bank itself, RBI has bought around 4.7 tons in the month of Feb. The RBI gold holdings at around 817 tons has been an all-time high.
Beijing bought more gold than any other central bank last year, and Beijing is not done yet.
The recent boom in the stock market has prompted investors to diversify their portfolios.
In 1990, 1 kg of gold could only buy you a Maruti 800. But today, that same 1 kg of gold can buy you a BMW 5 Series car. Indians are consuming gold in any form that they can get their hands on right now, be it physical, digital, or bonds. And the Indian middle class accounts for nearly 50% of the country's gold demand, with South India alone comprising 40% of the country's gold consumption. But what you may find surprising is that governments and central banks are also participating in this gold buying frenzy. The Times of India reported that RBI has purchased over 13 tons of gold in the first 2 months of 2024 alone, increasing its overall reserves to over 800 tons. And India is not alone here. 2022 was an exceptional year for gold across the world, when central banks globally bought a staggering $70 billion worth of gold, which was the highest in 73 years. Based on data from the IMF and the World Gold Council, Turkey and China have been leading the charge this year, being the top 2 buyers of gold. And central banks have collectively added 39 tons of gold to their reserves in January 2024 alone. With such a huge demand from citizens and governments alike, it therefore seems logical that gold prices continue to break records every single month. But while you know that gold prices are increasing, do you know what is driving this increase in gold price? Why do we assign such a high value to this chunk of metal and not iron or copper? And why is gold universally accepted as a currency and mode of payment? To find out the answers, let me first help you understand why gold holds a formidable monetary value in the society. The earliest documented usage of gold dates back to 4500 BC, when Egyptians used gold in decorative arts due to its shiny and aesthetic nature. And by 1500 BC, gold had become an essential element in international trade all across the world. Think of the place that the US dollar holds as a globally accepted currency today. Gold had started holding the same status back then. You see, modern day currencies like the US dollar, the British pound, or the euro are recent constructs, and they are only a few hundred years old. Before that, you could pay for stuff in 2 ways. One was the barter system, which basically meant exchanging one thing for another. If I grow rice and I want apples, I would go to the market and exchange 1 kg of rice for a few apples. The second was paying directly in metals like gold, silver, or copper. So you could instead buy those few apples with a silver coin as well. Eventually, the barter system phased out and gold became the standard currency. While some kingdoms used gold and silver directly without any marking or stamping, other kingdoms started stamping gold, silver, and copper coins. This coinage was first introduced around 600 BC by the Lydians, an ancient kingdom in what is now Turkey. The Lydians made their coins from electrum, a natural alloy of gold and silver, and these coins were stamped with pictures that acted as denominations. Paper currency, as we know it today, was actually introduced by the Chinese in 7th century AD, when they basically said that while a currency note practically is a piece of paper, it is worth a fixed amount simply because the king promises so. The king could promise so because he had wealth, which was usually in the form of gold, so it was still essentially gold that was holding all the value. Paper currency gradually became popular and the use of gold in coinage faded out, but gold continued to be the core of the financial reserves of every country. As late as 1971, the US dollar was based on the gold standard. It meant that for every dollar in circulation, there was a certain amount of gold kept in reserve by the US government to back its value. It was only after World War II that the global economy gradually shifted from gold-based reserves to US dollar-based reserves. And I'll explain why. After World War II, the US emerged as the strongest economy in the world with the largest gold reserves. And it used its monetary and political influence to turn the US dollar into a global replacement for gold. But this does not mean that gold was abandoned. It continued to hold its position as the financial backbone of the global economy, and the wealthiest nations hold unbelievable amounts of gold even today. The US leads the table with over 8,000 tons of gold reserves today, which accounts for almost 78% of its total foreign reserves. It is followed by Germany, Italy, France, Russia, and then China. But this still doesn't answer what is causing the rise in the prices of gold decade after decade, right? Well, if you break down the economics of any commodity to a unit level, the price is determined by just two things: the supply and the demand. So first, let's look at the supply of gold. You have to understand that gold is indeed quite rare. According to the World Gold Council, just over 190,000 tons of gold has ever been mined to date. This may sound like a lot, but it really is not. If all the gold ever produced was melted down, it would fill just over 3 Olympic-sized swimming pools. And mining and producing new gold is expensive, with limited mines left in the world from where gold can be produced profitably. And since there is only ever going to be a fixed amount of gold in the world, while the demand will continue to increase with the growth of the global economy, the only way the price of gold will go in the long run would be upward. It is simple supply and demand. If you made it this far, please subscribe to my channel. I promise my content will add value for you. Moving on. But wait, the statement that demand will continue to increase because of the growth of the global economy is very vague, isn't it? So let's understand what exactly is driving this demand and ultimately affecting the prices of gold. The demand for gold is driven by three types of purchasers: individual investors like you and I, institutional investors like gold ETFs and mutual funds, and finally, central banks like the RBI and the People's Bank of China. Now, for investors, both individual and institutional, the reason for buying or selling gold is very simple. They are making an investment similar to how they would buy and sell stocks. But then, why do the central banks of countries still keep gold instead of the US dollar in their forex reserves when the dollar already has universal acceptance? Well, it is precisely because the US dollar has gained universal acceptance, and this is where the geopolitical angle comes in. You see, accumulating US dollars as foreign reserves is a double-edged sword. Yes, you can use your dollars to pay any other country in the world, but it also means that if the US decides to go against you, then your foreign reserves become absolutely useless. This is exactly what happened with Russia after it invaded Ukraine. The US imposed sanctions on Russia and froze about 300 billion US dollars of its reserves.
When Russia invaded Ukraine, the West cracked down on Moscow's reserves. They went after Russia's financial assets, Russian wealth, controlled by the West, $300 billion. This was part of Russia's foreign exchange reserves. The West froze all these accounts, so Moscow can no longer access its own money.
$300 billion of Russia's central bank assets that have been frozen by the West at the start of the war.
Now, you might ask here, how could the US access the dollars lying in Russian banks, right? Well, that is because central banks usually do not physically store foreign reserves. When Russia had 600 billion worth of forex reserves in the US dollars, it does not mean that physical notes of US dollars worth 600 billion were actually lying in their central bank. That would be a logistical and storage nightmare. Any country usually keeps its forex reserves in the form of deposits or securities, mostly in the US or other financially stable countries like Switzerland or Singapore. When Russia invaded Ukraine, the US imposed sanctions and used its political influence, asking these countries to freeze all the US dollars that Russia was holding with them. All countries are essentially at the mercy of the US if they hold US dollars. And this is precisely why Russia and China, the top geopolitical rivals of the US, have been leading the tables when it comes to moving away from the US dollars and buying gold for their forex reserves. Unlike US dollars, gold is a universal currency and it cannot be frozen by any other country. Another benefit of keeping gold in forex reserves is that it acts as a protection for fluctuations in a country's currency. For example, the Russian ruble lost about 50% of its value when the Ukraine war started. At this time, if they had to pay for immediate imports using the ruble, they would have suddenly become much more expensive. But since they had gold stashed away, they could use that as a backup, hoping their currency would eventually recover, which it did. So gold acts as the perfect stash of reserve for any country, no matter what the geopolitical weather is like. And that is precisely why central banks of all major countries are hoarding it. So this explains the larger picture of why gold is always in high demand, why its supply is limited, and why the prices would eventually go nowhere but upwards. But wait, all of us can't expect to hold gold for several decades, hoping to see its price go up someday, right? We need to know what determines the short-term prices of gold. We know its price would be higher 30 years later than what it is today. But what decides its price 3 months or 6 months or 2 years from now? Well, there are a few factors that determine the short-term price of gold. The first one is the US dollar itself. It is the most powerful currency in the world today, and the price of gold is usually listed in US dollars. So when the value of the US dollar drops, the value of gold increases, simply because now you can get more dollars per gram of gold than before. And this is proved by historical data. The yellow line tracks the price of gold, while the blue line tracks the US dollar against other currencies from 2006. When the financial crisis of 2008 hit the world, the dollar initially experienced a fall due to the shock, and then it saw a rapid increase as people started parking their wealth in fiat money due to stock market fears. In the corresponding period, gold prices first increased when the dollar was low, and then decreased as the dollar strengthened. The same pattern can be clearly seen in the graph, with stark contrast between the two in 2011 and 2016. So when the US dollar rises, gold prices fall, and when US dollar falls, gold prices increase. The second is the interest rate set by the Federal Reserve, which is the central bank of the US, also called the Fed. I'll explain this simply. See, the central banks of all countries control their nation's interest rate on loans or deposits to control inflation. And this includes the Fed, which is the most powerful central bank in the world. If the interest rates are increased, banks offer higher interest on the money saved with them. So people prefer keeping their money in the banks, draining the cash out of circulation, and decreasing the demand for goods. As the demand decreases, the prices become lower and inflation is brought down. Similarly, if interest rates are decreased, then inflation goes up. This is a very simplified explanation, but this indeed is how economies and inflation work. Now coming back to the Fed rates and gold prices. When the Fed increases interest rates, it means that fixed income assets like deposits and bonds become more attractive with a higher return. So people start taking their money out of assets like gold and start putting money into bonds. Since more people are selling gold, its value falls. And this is why when the Fed increases interest rates, then the value of gold decreases. And when the Fed decreases interest rates, then the value of gold increases. So to sum up what I have explained so far, if the US dollar or the Fed rates increase, then the prices of gold decrease. If the US dollar or Fed rates decrease, then the prices of gold increase. But something very strange has been happening over the past 2 years. The Fed has been increasing interest rates so aggressively that it is the highest in the last 22 years, while the US dollar index has also been increasing steadily in the same time. Now, as per the relationship that I just described, if the Fed rates and the US dollar are increasing, then the prices of gold should fall, right? But what has been happening is the exact opposite. Gold is seeing a rally in prices like never before. So why are gold prices defying their decades-old relationship with the Fed rates and the US dollar? Well, that is because of the third and most important factor on which gold prices depend, and that is global demand. You see, geopolitical tensions have been extremely high over the past 2 years. Ever since China introduced the world to COVID and Russia invaded Ukraine, the actions of the US against these two countries have shaken the world's belief in the traditional financial systems. And as a result, countries are increasingly moving towards de-dollarization, where they are now basically moving and diversifying away from the US dollar as much as possible. This has resulted in countries replacing their US dollars and forex reserves with gold, and that has given rise to an unprecedented surge in the demand for gold. And central banks are not alone in driving this surge. With all these geopolitical tensions and uncertainty about the global economy, investors are also flocking to gold as their safe haven asset. As a result of this increased demand, the typical market response to rising Fed interest rates and increasing dollar value has been overridden, and gold prices are now higher than ever before. So now, the final question is, should you really be investing in gold even when its prices are so high right now? Well, given the geopolitical scenario right now, I don't think anything is going to change soon. The Russia-Ukraine conflict is nowhere near coming to an end, while China and the US continue to be at loggerheads. If anything, the geopolitical tensions are escalating with Israel's conflicts with Gaza as well as Iran. With the stock market being at all-time highs and experts claiming that a stock market crash is just around the corner, if and when the market does crash, it will only take gold prices higher, as people will take their money out of stocks and park them in safer assets like gold. And in any case, as a rule of thumb, you should hold at least 10 to 15% of your investment portfolio in gold. It is a diversification strategy to keep you safe from market risks. Let me know in the comments where you think gold prices are headed right now. Subscribe here and follow me on LinkedIn and Instagram. The link is in the description below. Until I see you in the next video, goodbye.